Good morning, everybody. It is Friday, September 25th, 2020, and we're going to talk about hedging. And I think I'm going to probably show you a couple of ETFs that you should trim because I believe that you own them. And then we're going to talk about gold. And I think that gold might be the safest risk-reward investment out there at this point now that it's pulling back. So if you haven't built a gold position, I'm going to explain to you why it has a place as an alternative investment in your portfolio, why it should basically be taking the place of bonds, and we'll go from there. But we had talked about quite a few things with gold over the last couple of years, so we're going to tidy that up a bit. And one of the things that I think is in play at this point is that gold is very likely to go to $3,000 per ounce, a little bit over that. But there's a possibility that it runs all the way to $5,000 an ounce. And that depends on probably who is elected and what the monetary policies are. So we'll cover a lot of that. So I'm going to start with this chart that you see right now. And this is the same chart we've been using since March. The warning symbol here for the later part of 2020 has been up since about June, maybe even May. And I think that you are seeing what I've been talking about over the last 4 weeks or so. So the stock market is down about 10% in the last month. And that is the slow drip out of all that stimulus money that people are now having to spend. And as I have told you for 2.5 years, the harbinger, the canary in the coal mine, is unemployment. And what we saw this week, which I told you was coming, was a tick up in unemployment that nobody really expected, except us. So we're going to take a look at that. A couple of years ago, about 2.5 years ago, I welcomed you to President Trump's economy and markets. And we talked about how the first year of anybody's term is largely a continuation of the prior administration's term. It's not until the second year of a presidency, when they appoint their own Federal Reserve chairman, and they've had time to pass their own laws, that the president's economy really takes hold. So 2017 was really a continuation of President Obama's economy. The stock market you could put on President Trump. However, the economy itself didn't really take the characteristics of Trump's policies until 2018 and 2019. Some of the things I talked about, and this article was an editor's choice that was read, I believe, like something in the range that I could check, 70, 80,000 readers, which is a pretty good number for Seeking Alpha. Most articles on Seeking Alpha, 10 to 20,000 reads if you have some following. I've got about 20,000 followers, so that's a typical read for my articles. But this article, again, it was pushing 100,000. President Trump appointed Powell, and at about the same time, he started his trade actions with China, and we were now into the deficit-driven tax cut induced economy. So we saw in 2018 that the tax cuts were juicing things up, but at the same time, the dollar was getting much weaker, and we'll cover that in just a minute. So the deficit spending, which didn't go towards building anything, rather it was just tax cuts that went about 88% to the top 1% of the population, resulted in hoarding. And that hoarding of capital has not been good for the economy ever since. As I've shown you several other times, all of the economic numbers in America topped out in 2018 and started to roll over. That was partially reflected in the fourth quarter of 2018 when the economy stalled and the stock market had that very large correction at the end of the year. What I'm concerned about right now is with the election, if we see a continuation of these policies, which I covered in this article, if we see continued trade war, if we see a lack of even an attempt to balance the budget, and we know that we won't get there anytime soon, but moving in that direction is what we need to accomplish, then we're probably going to have a big problem in the next couple of years. What we need to be doing is building something, and we need to be moving into the future economy. We need to be moving towards the places on the barbell that I've identified that are good for the economy. If the federal government doesn't support this end of the barbell and try to keep us from getting inflation, we could have a pretty wicked downturn. And in fact, I believe that the fourth quarter and probably into the first quarter, the markets will be pretty choppy. I'm not sure how deep a correction will get, but it could be significant. Why is that? Well, the second wave of coronavirus is happening, and a lot of the things that I said back in March and April and May are all coming true. The good thing about the second wave is it shouldn't be any worse than the first wave. We know that treatments are getting better. We know that there is at least somewhere in the range of 20% of the population has a little bit of immunity to this at this point because they've already had it. And then there's a little bit of cross immunity. I believe that's the right term. If it's not the right term, just some people have a greater natural immunity. And as somebody who's getting over it, I can tell you that during the time that you have it, if you have symptoms, you do get scared because the symptoms can be pretty significant. I never crossed the threshold to shortness of breath or some of the things that you would attribute to a more serious condition. For me, it was just a very severe cold and flu that lasted 2 weeks, very draining on energy and things like that. For somebody who wasn't as healthy as me, it can be dangerous. And you know that it's dangerous when you have it, because once you get the symptoms, you're like, oh my God, does it get worse? Because this is already pretty bad. And because of that, the coronavirus is a drag on the economy because people don't do the things that they would normally like to do. Travel is down, eating out is down, but even some of the ways that we conduct business have changed. And there's knock-on effects in the energy sector, which are huge. And there's knock-on effects in the real estate sector, which is huge, because all of those things affect the finances at the banks. So with coronavirus, you get necessarily a slowdown in economic activity. I've shown you the chart for velocity of money. It was already heading down for 20, 30 years, but it fell off a cliff this year. There is very little transactional support for the economy right now, and that's why inflation is so low. And the Federal Reserve actually has this equation wrong, and at some point they're going to have to push back. One of the reasons why the Federal Reserve did not commit to new quantitative easing right now is because they know it probably doesn't much matter for economic impact. You can add more liquidity, but at this point, who's building a business, right? I mean, there are some people who are smart enough to know that during periods of creative destruction are the best times to invest in a business, but most people are closing. And we have seen record numbers of small businesses close. And we're starting to see the layoffs that I demonstrated last week, that I showed you last week, come back to the market. Nobody expected unemployment claims to go up, yet they did. And in fact, unemployment is much worse than you think it is, because the unemployment numbers of the federal government are calculated in a way that they don't really take into account gig workers, small business owners, things like that. There's all sorts of people who are unemployed, but they're not really in the counted part of the system. So we're looking at something along the lines of 30 million people who are at lower incomes today than they were at the start of the year. It's a massive number. And now the Federal Reserve and the U.S. government relief efforts have kind of stalled. We already know that the Federal Reserve hasn't been adding money, right? Basically just kind of chopping along. A couple of treasuries, mortgage-backed securities. And we know that Congress may leave town without a new stimulus package. If you're not reading Value Walk Premium, you should still probably get this one. This is a bargain. And they have the screener for 13F. So what all the hedge funds are invested in. If there's not a stimulus package before the election, and I think that the odds have risen that there won't be, you're going to see in October and November pretty significant upticks in unemployment, which have already been announced, so they'd have to be undone. And it doesn't seem like that is going to occur. So with 30 million people plus unemployed, what happens? Well, the people that you should really think about as an investor are those people at big companies making good money who are losing their jobs right now. And like I said last week, I believe, and think about it from your own perspective, given what's going on with coronavirus and the fact that you can take up to $100,000 out of your retirement plan, I think a lot of these people who either A, can't get jobs right away, or B, just choose not to, are going to borrow from their retirement plans. And that's after already no longer putting into the stock market anymore via their retirement plans because they're unemployed. So we're about to see 1 million to 2 million people added to the unemployment rolls over the next month or two. And that's going to continue to put big pressure on the stock market. One of the reasons why the stock market stopped surging in the last month is because some of the big call buyers, and I'll show you some of the charts from Sentiment Trader, the big call buyers are gone. So you still have the little call buyers, the little Reddit guys and Robinhood guys who think that, hey, I can game the market. I'm a superstar trader because I made money back in, April, May, and June. Well, in July, in August. The reality is that without the push from the Fed and without SoftBank and some of the other big institutions buying calls, pumping things up, there just isn't the liquid fuel to power the stock market much higher. And in fact, we've been running into resistance levels. A month ago, I said risk off could happen fast and hard. And actually, it's been fairly orderly, but look at this peak, down 10% in a month, about 11%. It's jitterbugging right here at these Fibonacci lines, go figure, a 1.618 line, and then a 1 line. It's jitterbugging right here. So either we need something, a stimulus package, to shoot the market up, or if there's no stimulus package, I believe you see it come through this support and start taking out some of these levels. This level right here, QQQs in the 230s, is one of those areas that we would want to be aware of. This could be a place where we want to start to invest if there's not horrible downward momentum. If there is horrible downward momentum, then they could go straight through this area, take out these levels, and get all the way down to a QQQ of around 200, low 200s. And if things really got bad, you could see us get all the way down here into these Armageddon scenarios. Now, what could create the Armageddon scenario? Again, if the second wave was worse than anticipated, the Federal Reserve and the U.S. government failing to have any types of relief efforts, which I believe are coming. I just don't think that they're going to come in the next month or two. And then what if the trade conflicts got worse? So this is really a Trump thing. Trump wins, probably the trade conflicts do get worse. And I would anticipate that our allies really jam it to us if Trump wins, because they've been trying to wait him out. And if we reelect him, they're just going to start doing other things. It won't be a matter of waiting for America. It'll be a matter of turning away from America. And that'd be very bad for our economy. In fact, in our standing in the world. So now the risk off has started to happen. What do? Well, there's an article in Market Watch the other day. The tell is something you should probably read. It talked about what the short sellers are doing. And I asked people what was my takeaway from this article. So on the chat for the last day or two, I asked, what do you think my takeaway is from this? Well, my takeaway was this. The short interest in biotech started to dry up because people are thinking, well, hey, there's going to be a vaccine, so biotech is going to spike up. I'm not so sure that's true. As I've told you, I don't think there's going to be a lot of winners in biotech from vaccines. There'll be one or two. And if it ends up being Johnson & Johnson or Merck, they're not going to make a lot of money on this because they've promised to keep these vaccines cheap. So we take a look at XBI, and it's been on a pretty good rally under the Trump administration, fell back, and then here shoots almost all the way up, straight up, because of all the money pumped into biotech. So a lot of these companies, combination of grant money and hopium, stocks have charged up. For whatever reason, it picked out this Fibonacci level to start puttering sideways and doing that jitterbug thing that I talk about. There's very few people short this right now, which means that it could elevate all the way up to here. But honestly, this seems like a pretty good plateau to start buying puts on XBI. So I am likely to buy puts on XBI if it gets to about 112, 113, which isn't too far away. Very easy to see that this could dive with momentum, could definitely get into this red box. So if the options are priced right, I would probably buy a put option, probably a 105 or a 100 right in this area, with the idea that we could see it go down to 90 or 80 or maybe even in the 70s. And that would be a hedge against the hopium of what's going on. And consider, I've told you before, that the market seems to have been keen. The underlying charts and quantitative numbers appear to be saying that basically the last election is the fulcrum. We could see the stock market completely erase the Trump rally in the next 3 to 6 months. And if that happens, having a couple of shorts makes a lot of sense. So not only do I want to be short the oil stocks because they're doomed with whoever wins, but they're more doomed if Biden wins. And I think that some of these biotechs are just so ridiculously overvalued. I think that this period here, see how the market was choppy? That's indicative of the real value of really where this should trade. Peaked out, dropped after 2018, never recovered its highs until the money got pumped in by the government and everybody wanted to try to speculate on which one of 180 companies was going to get the vaccine. That's not going to be very profitable anyway. So I think that this is probably a pretty easy short as far as shorts go. And I think I'd probably be looking at January puts at about 100. And we'll have to figure out the pricing here over the weekend. And we'll talk about it on Tuesday. So that leaves us with the ultimate hedge, gold. And when we first started buying gold, I told you to buy gold stocks over actual gold. And why was that? It's because gold stocks are leveraged to the price of gold. And as the price of gold goes up, the gold miners became more and more and more profitable. And that's going to continue to happen. However, we have to keep in mind that gold is getting harder to find and harder to mine at low prices. So it's really the very best miners that you have to focus on. Who are the very best miners? That's Newmont Corporation and Barrick Gold. Barrick Gold, of course, Warren Buffett just bought into, and Newmont has been one of the top 5 or 10 stocks on the S&P 500 this year. So between Barrick Gold and Newmont, I know that people want to try to make the hero call and find other gold producers. I get it. And there are a handful of companies out there where if you truly understand their mining setup, you could invest in them. Core Mining, which was our speculative small cap pick, has done pretty well. right? It was very choppy. They even had a setback at one of their mines, and I think it's a stock that you should be selling right now, because I just think that the quality is a concern. Although because they've concentrated in America, North America, all the reasons that we bought it are still good reasons. I just don't know that it has the huge upside that the best miners with the best assets, Newmont and Barrick, have. So you could keep some of those small speculative positions, but I don't think that you need to do that because the tried and true steady Eddie companies are going to do pretty well. Now, I saw an article this morning on Medium, which is a bit of a cesspool as far as some of the stuff they write or that gets published there. And it's talking about the collapse of the dollar again. And again, I will reiterate, the dollar is the strongest currency on the planet. It always will be. It's only low from time to time because we beat it up deliberately. If we let the dollar just do what the dollar does, which is compare favorably to every other currency from big countries on the planet, and we're not going to talk about little currencies. I mean, like the Swiss franc, that's an anomaly, right? It's not a major financial powerhouse. It's just that they have their own little insular thing there that's very, very well kept. But of the big economies, the big currencies, the dollar, the yen, the euro, the pound, right? The renminbi, the dollar has so many advantages that even when we do bad things with our budget, when we do bad things with our economy, when we do bad things with policy, it sets it back. But all these people who have been talking about dollar collapse my entire career have been wrong, and they will always be wrong because currencies are relative to each other. And for the dollar to collapse, that would mean that there'd have to be a better currency out there. And the euro is a possibility, but the reality is we'd have to let the euro supersede the dollar. We may do that. If President Trump wins, he's deliberately been trying to lower the dollar because he believes that exports depend on it. We know as smarter people that that's not true anymore. Exports do not depend on having a low dollar. Exports now depend on machine learning and being close to resources and being close to end consumers. Why is that? Because the difference in labor costs and currency costs pale in comparison to being able to wipe out transportation costs and what used to be a big spread on labor costs, because a robot here is no different in price than a robot there. So you just want to be closer to your end consumers and your resources. And to that end, the United States is in a great position because we have a large economy with good-sized economies on both sides of us, and basically every resource in the world is on North America. So if we need copper, we need steel, or we need any of those things between Canada and us and Mexico, we have it, concrete, right? So it is not necessary for us to blow up the dollar to have good trade. And in fact, supply chains are moving back to the United States, and it has nothing to do with the tariffs or taxes or anything else. It has to do with we don't need to send jobs overseas anymore to save labor costs because we'll just automate over here. And maybe we'd only get one job out of it for every 3 that we lost over the last 30 years, but it'll be a very good paying job. So we know this gold is becoming more scarce, and that is the supply and demand aspect that we have to keep in mind. So there have really been no major gold discoveries in quite a long time. And you can see just by the shape of this chart, gold discoveries over the last 30 years have dried up. There's not much more gold to discover. It's just like oil. It's out there, but it's hard to get to and it's expensive to get to. So while I wanted to be mostly in gold miners this year, I'm now getting to the point where I want to equalize my position between gold and gold miners. I still want about 16% of my portfolio to be in gold related items. Why is that? The traditional 80-20 portfolio, 80% stocks and 20% fixed income for a growth investor, or the traditional 60-40 portfolio for a retiree, which is 60% equities, about 40% fixed income, doesn't make sense anymore. If you're a growth investor, you shouldn't have any bonds at all, zero. But you still may want to have something that offsets the risk inherent in equities. And for that, I think you can use gold and for a couple percent, even cryptocurrency. But I have said in the past, I believe Bitcoin and maybe Ethereum, maybe Stellar Lumens. There's 5 cryptocurrencies I keep track of. Let's focus on Bitcoin. Bitcoin really should be something that you say, well, I have money in the bank that's really just emergency money. That's where you should take some money and put maybe 10% or 20% of your savings into Bitcoin. It doesn't belong in an investment account, because ultimately if Bitcoin works, and I think coin flip that it does, I don't think it's any better than a coin flip, but I don't think it's any worse than a coin flip. If Bitcoin becomes a thing, it's because we start to adopt it for transactions. It becomes a unit of exchange, a medium of exchange. And that's happened a little bit. Slowly people are adopting it because now you can use it on Square, PayPal. It's coming to Venmo. I believe might be going in that direction too, because that's part of PayPal. So if, and at Robinhood you can buy Bitcoin, and I believe at TD Ameritrade and most of the brokerages now. So if Bitcoin is going to become a thing, it has to become like a currency, and you would never expect your dollar today to be worth $75 tomorrow and then back down to 50 cents the day after that. Currencies have to be more stable. Even if they drift down or drift up, they're supposed to be more stable, because that's what gives people the confidence to use it for transactions and to keep it in a bank. So for cryptocurrency, I'd say go ahead, put a few percent of your savings into Bitcoin. Start to learn how to use a purse. With gold, the correlation, there you go. The correlation of gold to stocks, you can see, is much lower than stocks to stocks. So SPY to QQQ, a 93% correlation. But SPY to gold stocks is only a 0.16 correlation, and only a 0.01 correlation to actual gold. Now, the correlation to bonds is actually a bit negative, but it's close. So you can use gold as your hedge against equity risk because the correlation is low. And I think for somebody who would normally be a 60-40 investor, rather than having 40% in bonds, I'd probably go about half of that into the gold related. And if you want to have bonds just because it's what you do, then you got to be very careful with your bonds, because long interest rates, if they do what I think they're going to do, are going to go up in a few years. And that'll be very bad for any long duration bonds. And that was one of the things that I talk about, not only in the past. I did an interview where I said that helicopter money is inevitable 2 years ago. And I stand by that because of the ways that we can defray money, devalue money. We have quantitative easing, and with quantitative easing, we create a debt. So the debt is deflationary. So although the cash goes into the economy now, which is inflationary, there is a future deflationary asset, debt, that is waiting out there to suppress that inflation. Helicopter money, on the other hand, is supposed to be, if you have ever read Milton Friedman, a one-time massive drop that fixes problems that hopefully don't come back. Modern monetary theory is just a way of printing money to finance deficits. And the problem with modern monetary theory is that, imagine this, call the country Japan. We'll call it Japan. Imagine that they just kept printing money to try to create inflation. Now, Japan actually has done massive quantitative easing, and they keep creating deficits on their own balance sheet and their own currency with the idea that there's no ill impact. Well, Warren Buffett talked about that. He said, if we could do that and make it work, wouldn't you think we had figured it out in the last 1,000 or 2,000 years? The reality is that the deflationary impact at the back end is what suppresses the velocity of money. In order to get out of this problem that we have, which is completely unpayable debt, and a system that is designed right now to have hoarding at the top, is we need to simply print one gigantic piece of money and pay for a whole bunch of things that we need to build and fix. It's going to happen. There isn't another choice other than what we're currently doing, in which case we just set ourselves up for the next financial crisis. There is no way around that what we're doing will cause a financial crisis. It's happened once before, it's going to happen again. In fact, it's happened several times before, the most recent being 11 years ago, 12 years ago. And I know a lot of people have forgotten about the financial crisis because, hey, we papered over it. And things have been pretty good until recently. We are never, ever going to pay our debt off because it's just too big. And if we keep adding to that pile of debt, eventually the deflationary pressures turn into hot money turning cold, just like in 2008. And everything falls off a cliff. And then are we smart enough to do something different? Or do we do the same damn thing? I don't know the answer to that. I know that helicopter money theoretically and logically makes sense. I know that MMT does not, because the constant drip of money into the economy, you end up becoming a banana republic. Everybody loses confidence in your currency. The dollar is the free ride of the planet. And any American who doesn't understand that doesn't try to understand it. Our standard of living is directly tied to the fact that the dollar never gets too beat up. And despite people saying collapse, 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 they've been wrong. President Trump wins, it could happen because he kind of wants it to happen. He said he wants it to happen. I've stopped doubting him. When he says he wants something, I believe him now. I don't know that I ever agree, but I believe that he wants what he says he wants. So if President Trump wins, we'll continue to see the dollar get decimated. And as I showed in this chart here, when the dollar gets decimated, we get a financial crisis. This is 2008. So it got repaired under Obama and then finally really took off, got into the trading range where it belongs, and it got even a little too high. You know, this is the area where it needed to turn back down, and it did. Then it got all the way down to support, and now it's come back, and now it's started to approach support again. That's support zone. You can see the structural nature here, right? Anytime that the prices go through the same area over and over again, that's representative of a sort of equilibrium. If President Trump wins, he's going to want to smash the dollar. And if it goes through this zone, it starts heading down here, we're going to get a financial crisis. It's really that simple. Now, in that case, you don't even want probably to hold on to your gold. Probably goes just, I don't know, I think maybe buy Swiss francs, which I've looked at. And in the plug and play portfolios, I'm taking out all the currencies and I'm creating a separate section because you really can't trade the currencies without using options or futures. There's no point to it. The movements are too small. So you have to decide, do you want to be a true hedger with your currency exposure? I know I have several clients and consulting clients who are international, and they have pounds, and they have loonies, and they have peso, and they have Australian dollars, and they have all sorts of other currencies. For us as Americans, we can hedge by buying some stocks that maybe have foreign currency exposure. What did Warren Buffett just buy? Rather than buying Newmont, which is on the S&P 500, he bought Barrick. Not just because it was cheaper, but what? What is the difference between Barrick and Newmont? Barrick's Canadian, so he gets Canadian exposure there. So the Canadian dollar. And in an era where we are threatened by man-made inflation, Canada is a resource economy, so the loonie could get stronger. If Trump wins, Barrick Gold is a hedge against a Trump win. That's why Buffett bought it. He didn't suddenly fall in love with gold, right? Buffett's talked about gold being a junk investment for a long time. For Warren Buffett to get scared enough to buy Barrick Gold, that should shock the shit out of you. It should frighten you that Warren Buffett, after 60 years of saying don't bother with gold, bought Barrick Gold. He's afraid of the dollar getting crushed in a Trump second term. That's what he's afraid of. Now, if you've noticed, Trump has been building the exact same barbell that we're building. What did he just buy? Snowflake and some other tech stocks. And then he buys a gold stock. And he dumps his American banks. Think about what he's saying. And he buys Japanese brokerages. Think about what he's trying to tell you and what he's preparing for. So, pretty simple approach here. I'm probably going to buy some Barrick Gold. Never hurts to be invested in a company that Berkshire Hathaway is buying on the dips. So right now, Barrick Gold, this is a pretty classic formation. It's going to break out. So on this pullback in Barrick Gold, I think right now, well, this isn't the one gold I want. Still the same formation though. Look, still the same cup and handle. So on this pullback, you can probably start selling puts on Barrick Gold. I'd say $27 puts on Barrick Gold, December or January. I think you can sell those right now, today if you want to. Probably doesn't go below mid-20s. Why? Because if it gets too cheap, who's going to step in and buy it, right? Anytime that Buffett is an investor in a company that you're an investor in, there's a floor there at some point because they'll buy more. They've got all that cash. So I think you should be selling the puts on Barrick Gold, 27s to December probably. And I think that's premium that you get to collect. And if it gets put to you, so be it. That's awesome. Newmont, I still think has a shot to run up to 100. So on this pullback, again, I don't know why I picked out this fib level, but on this pullback, take that back. I drew that. I called that a top. Let's redraw some of these. And those look pretty legit. I don't think we need those other lines. So it almost got to this one, full one. It's coming down. It's at a 0.786. It normally won't stop there. Probably get to the 618. So lower 50s on Newmont, I think you probably have to be a buyer, or you can go and sell puts down there. Could this get all the way down some of these other levels? I guess. And in a big sell-off because of margin calls, it could get all the way down to this 618 level. I mean, there's a lot of support here, right? Start hitting a lot of support. So it's a pretty wide range. I can't imagine it actually getting back down here. I think in my way of thinking, I'd have a hard time not buying it in there. I'd have a hard time not buying Newmont anywhere around 50 or 40s. GDX is almost into a buy zone, coming down. You could probably start selling $35 puts, $36, $37, $38 puts right in here if you wanted to, or you could wait just a couple more days. Gold doesn't usually do well into a presidential election. And as I've told you, the dollar's already started to firm. What did I tell you about a month to 2 months ago? I said when the market starts to anticipate a Biden victory, the dollar will start to firm. So our thesis is that gold goes up either way. Under Trump, it probably goes up a lot more after a big dip. So under Trump, there's probably better trading opportunities because there will be more volatility. But under Biden, I think there's more predictability. So either way, you should be able to figure out a way to win. So here's a chart that I put on. I guess I have it in here too. Here's a chart I put on that article. I think it's a pretty sure thing that gold gets to around 3,000, low 3,000s. If Trump wins and he does crush the dollar, I think you could actually see it jump all the way up here to around 5,000. So you're either going to win or you're going to win a lot more. And it'll take years. It'll take 3, 4, 5 years. But I think it's probably a pretty good idea. Again, see this formation. That's a very bullish formation. So you're going to want to buy the pullback. I mean, heck, even if it only goes to 2,400, who cares? It's still pretty good. So any number in the 150s, you're going to want to buy GLD. But I'm actually already selling puts. I think selling the $170 puts and asking for around $10 in premium is worth your while. go to trusty Yahoo because it's easy. You take a look at the options, and you can do the 18th of December, which is normal, or they have a December 31st contract. I would probably stick with the 18th if you want it put to you. I think the last week of the year could be a bit of a rally, right? That'd be typical. So your 170s are only at about $5 right now. And people are like, well, but why are you telling me 10? Because you want 10. Because you want an average price between 160 and 155. So you sell the 170 for 10, which would give you an average price of 160, which is the more ideal price zone, more ideal buy zone. I mean, because it might not get down there, but it might, for some time, stay below 170, and then you get it put to you, and then finally you're back on that ride back up. Now, if you wanted to sell these puts for only $5, that's fine. You can do that. But I think the volatility is high enough now and more likely to rise. So I don't think you have to be click crazy. I think you can let the prices come to you. And most of us already have some GLD. So be selective in how you enter your trades. So somebody asked me, I've talked about helicopter money being added to the economy and about the Social Security lockbox that I've suggested would be a good idea as part of that equation. It doesn't matter. Helicopter money is helicopter money. It's going to be put into the economy to try to solve problems. I can't really speak to how they go about solving the problems, right? I mean, that's just something that I would like to see happen, but I can't say that they will do things exactly the way that I think they should be done. Last time the Federal Reserve Chairman called me was never, right? So, you know, to the extent that I've gotten to shake hands with a few politicians, I mean, that's the extent of that. You know, I can write all the articles I want saying, hey, why don't we buy the Fed balance sheet with helicopter money and stick those corporate bonds and other securities into the Social Security Trust Fund and start to create an actual trust fund for Social Security. Jam it with U.S. Treasuries and the securities from the Fed balance sheet, and then start throwing 20 or 25% of our withholding into the Russell 3000. I think that would be a fantastic idea. Will they do it? I don't know. In the age of AOC and Bernie Sanders, for me to say we should put a quarter of our money, our Social Security money, into the stock market, they go apoplectic. They go nuts. It's a great idea because it defrays inflation and it supports capital formation without the volatility of trading, right? It's basically the federal government who tells you through regular regulations at the Treasury Department that they want your 401k plans to have index funds in them. Well, if index funds are good for our 401k plans, then why wouldn't an index fund be good for a portion of Social Security? Well, the answer is because you have freaks on both sides who want to control the money. That's all there is to it. You have extremists on the right and the left who want to control the money or hoard the money. So while Bernie Sanders rightfully points out who a lot of the knuckleheads and crooks are, this idea that you could convince that wing that it makes sense to put 25% of Social Security money into the S&P 500 or Russell 3000 or whatever, because we know that about a quarter of your money in stocks is like the perfect offset for inflation. We know that historically that's about what it is. Sometimes it's 20%, sometimes it's 30%, but it's in that range. So, you know, imagine what the stock market would be like if Social Security was dripping money in every week. Now you would have the ability to regulate it in a way that it should be regulated, get rid of the high frequency trading, get rid of all the skimmers, and make it back into a true wealth generating, capital creating economic machine that Ray Dalio talks about. Everything really is a machine, right? So if we oil it the right way and we have all the widgets stuck together the right way, it works. Now, does that mean that helicopter money is different if we don't do it that way? No, helicopter money is helicopter money. It's money without attached debt. That's what it is. Helicopter money is true printing of money without the attached debt that comes from quantitative easing. The difference between helicopter money and MMT, modern monetary theory, is that modern monetary theory, they just keep the presses going, which constantly erodes the value of the dollar because it destroys confidence, right? If you always have to deficit spend, how much confidence can you have in that? Versus if you said, hey, we have a $15 trillion hole, let's fix it this one time and then move towards a more balanced budget. Yeah, the dollar would get hit the one time, but then people would say, hey, we're starting to normalize. We fixed a bunch of problems. Either way, under any of these circumstances, right? Under any of these circumstances, helicopter money, QE, MMT, the value of the dollar goes down. It may not go down as much relative to other currencies, but relative to gold and other assets, it goes down because they're more fixed. So gold, part of the thesis is that people will read the stupid articles out there about the collapse of the dollar and about the end of the world and everything else that they can talk about that's bad, because all of these marketers know that if they scare the hell out of you, you're going to buy what they're selling, or at least you're going to get them their penny per click. So have a more level-headed view and say, okay, the reason I'm investing in gold is because it's a good investment and the knuckleheads might spike it up so I can sell it really high. Gold's pretty certainly going to about this level, 2,400. I think it's probably going to this level, 3,400. And if we're really stupid, it'll go up to around 5,000. I hope we're not really stupid. I just know that it can happen. All right, I'll take one or two questions since we're still under an hour, and I can edit this down about 10 or 15 minutes. Anybody have any questions specifically about gold and currencies? Somebody asked about a stolen election and civil war. I will tell you this. I'm sticking with that Biden's going to win by around 10 million votes. There's no way for President Trump to try to steal that election. But if I'm wrong, and it's a 3 or 4 million vote election, and he can focus on attacking the swing states, I think that the violence that you saw in the protests will look like a Christmas party, because most of the violence in the protests, they've already been able to figure out that it was about 2/3 agitators who had nothing to do with the protests, a lot of right-wingers. It'll get flipped, and you will see the people who were accused by Fox News of being the agitators become the agitators. I don't know how violent it gets. I openly wonder if I should go to northern Wisconsin where I can hang out. I think some of the big cities, I think places like Portland, I think if you see the Trump administration go to the 6 swing states that they're targeting, and try to steal those votes by not counting mail-in ballots, I do think things get very, very rough. I do. I think that the people who claim to be the militia and the right-wing gatekeepers of democracy, I think that they're fascists for the most part. And I think that, and it's a small sliver of the Republicans. It's not like it's all Republicans. It's just, you got those extremists on both sides. And I'm just saying that the extremists will act extreme if there's any funny business. Now, to the Republicans' credit, they said there won't be. So I think that that is very hopeful. I actually think the odds of conflict are greatly overstated, but the fact that we have to think about it is pretty depressing. So we'll see. My guess, my analysis, all the numbers tell me Biden wins by around 10 million votes. And we get a stock market correction either way. Trump wins, Biden wins, it doesn't matter. Stock market corrects. And then you want to build your barbell. That's all there is to it. Just keep focusing on when my opportunities to build this barbell come up, what am I going to do? And right now, gold is pulling back, so we can add some gold. And I just think that we should go about half in stocks and half in physical gold at this point. And before we were about 3/4 stocks, you move to that 50-50 position. Pretty simple, nothing dramatic. The one thing I was going to tell you is, for those of you who own TAN, the solar ETF, it's pretty overbought. At a minimum, I think you should be selling some. I mean, that's pretty obnoxious. I think pretty certainly it comes down back to close to 40, low 40s. So if you bought tan anywhere in this area, I think you need to take some profits. Maybe sell half of your position and a minimum sell covered calls on the whole damn thing. Yeah, so as things get more volatile, I'll have more webinars if we need them, and we'll see. I'm hoping that we are on the slow path to normalization. However, these types of charts have to find reality. And as unemployment keeps ticking up, that is going to be the usher in of reality. So you should not be 60, 70, 80% invested right now. If you are, just understand you are taking a lot of risk, hoping for another puff on a cigar. RAC leveled off, maybe inches up a little bit more like it is today, but ultimately it's going to come back down in here somewhere. In this area right here is, I'd say, almost guaranteed. How fast is another question, right? Could it happen over the next 3 months, or could it take 6 months? I don't know. But the next quarter or two, I think we have to be very careful. I would probably be buying by December, because if Biden wins, that means we're going to get the mother of all stimulus packages in February. You might as well just anticipate it. So you buy on the tax selling in December, because if the tax code is known to be changing the next year, right, a lot of people will sell in December. They'll sell their losers and also sell some of the winners. So that'll be a chance to buy winners at a lower price. I'm not going to talk about specific stocks today that are on our list. Yeah, silver's okay. That ratio, the gold to silver spread, I actually had it up the other day. It didn't go back very far, the chart they had on here. But the gold to silver ratio has narrowed. It's not narrow, but it's narrow. It's not at the record that it was. Unless you're specifically, a silver person and you really understand that market, I don't know that I would bother with silver. I mean, as a precious metal, it doesn't compare to gold, and you can play that ratio, the gold to silver ratio, but that bet's half done already. So I would just stick with gold. It's simpler. It's a bigger market. You don't have to worry about liquidity, and I just think it's an easier trade. So like I said, you can play silver, but you're not going to change the world, right? You're not going to change the world. The world focuses on gold. So deal with gold. All right. You guys have a great, ladies and gentlemen, have a great weekend. I didn't cough the whole call, so I'm taking that as a victory. I will edit this afternoon and get it up tonight or tomorrow morning. And I've got a lot of articles to finish. Teresa has egged me on, I believe. I think it was Teresa. I'll finish some articles this weekend. Really, all those articles I started as my notes. So I will curate some of my notes for you. One last thing, I guess. And I'm going to write a how-to piece on how to use the buy zones better. When you see the price alerts, that doesn't mean automatically buy. It just means start paying attention. So we've had about 10 things hit our price alerts. That means start paying attention. That doesn't mean click, 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 buy. Remember, you still want to see oversold signals. And yes, some of the stocks out there have oversold signals on a daily basis, but I would encourage you to take a look at the weekly charts. If the weekly chart's not approaching oversold, I still think you should wait on most things. All right, have a great weekend.